History often moves silently. Disasters are rarely announced. Crises unfold in the shadows, long before headlines recognize them. The year 2026 is shaping up to be one of those moments. Beneath the surface of calm markets and reassuring narratives, a quiet but unstoppable force is building. A global debt pile that now exceeds $5 trillion in new obligations in just a few years, stacked atop an already fragile financial system. This is the trap. It is invisible to most, yet unavoidable for those watching the signs. The scale of the debt is not inherently dangerous. Used responsibly, it fuels growth, investment, and innovation. But what we are witnessing today is not responsible growth. It is systemic leverage, magnified by extraordinary monetary policies. Governments, corporations, and institutions have collectively borrowed at rates that outpace real productivity gains. Fiscal deficits are normalized, often celebrated. Central banks continue printing money to maintain liquidity and support markets, creating the illusion of stability. Yet, every borrowed dollar, every expansionary policy, is a future obligation. And when obligations reach unmanageable levels, the system itself becomes unstable. This $5 trillion in new debt is not small. It represents a critical threshold, the point at which traditional monetary interventions begin to lose effectiveness. It is the point at which trust in the system becomes conditional, dependent on continuous expansion that may no longer be feasible. Why 2026 matters. Several converging factors make 2026 particularly significant. Debt maturity waves. Large portions of sovereign and corporate debt are coming due simultaneously. Refinancing requires market confidence, liquidity, and low rates, all under pressure. Global geopolitics, trade tensions, resource conflicts, and strategic rivalries increase risk premiums and reduce the reliability of cross-border finance. Monetary fatigue. Central banks have exhausted many of the conventional tools. Interest rates are already low, and balance sheets are bloated. Economic structural weakness. Productivity. Growth is stagnating in key regions. Inflationary pressures persist, and supply chain vulnerabilities remain unresolved. These factors converge like tectonic plates. Individually, each might be manageable. Together, they form a systemic trap. The illusion of stability. On the surface, markets appear calm. Equities are supported by policy interventions. Bonds continue to trade at historically low yields. Headlines promise growth, recovery, and stability. But appearances are misleading. This is what makes the $5 trillion trap so dangerous. Most investors and the public see numbers on a screen and assume stability. They forget that markets are faith-based systems, relying on continuous trust and predictable intervention. When faith falters, numbers become meaningless. Paper promises lose purchasing power. Liquidity evaporates. Assets that were once considered safe suddenly carry risk. Gold, as always, responds before the public fully understands the danger. Why gold matters now. Gold is unique. Unlike currencies, bonds, or digital assets, gold requires no faith in intermediaries. It is physical, tangible, and globally recognized. Its historical role as a store of value makes it the ultimate early warning system for systemic risk. As debt reaches unsustainable levels, gold becomes a reflection of latent instability. It moves not because of speculation, but because it senses the stress in the financial system. At this stage, gold does not spike dramatically overnight. It rises quietly at first, accumulating signals from central banks, hedge funds, and wealthy investors who recognize the trap forming beneath the surface. The public may still be complacent, watching markets as if they were normal. But those who understand the mechanics know this is the prelude to a surge. The role of central banks. Central banks are acutely aware of the risks. They hold gold in reserve precisely because it does not depend on trust in government promises. By quietly accumulating gold, central banks hedge against systemic failure. They understand that paper assets, bonds, and even cash may lose purchasing power in a highly leveraged, stressed environment. The $5 trillion in new debt is effectively a stress test of the entire dollar-based system. Central banks are signaling that they see the danger, even if it is not publicly acknowledged. The psychology of the trap. Debt is not only a numerical problem, it is a psychological one. Markets operate on confidence, and confidence is fragile. Once participants begin to doubt the ability of borrowers to repay, the system becomes highly sensitive. Small shocks, a failed auction, a geopolitical escalation, or a sudden liquidity squeeze can trigger disproportionate responses. Gold, in this context, serves as a psychological escape valve. It absorbs fear before the broader market reacts. Rising gold signals that participants are beginning to question systemic stability, even if other assets appear stable. The mechanics behind the trap. The $5 trillion trap is not just about debt levels, it is about timing and interconnection. Debt is maturing simultaneously across sectors. Leverage in financial instruments magnifies exposure. Liquidity is concentrated in fewer hands, creating vulnerability to runs. Cross-border dependencies mean shocks in one region ripple globally. Gold senses these conditions. Its rise is a signal that the financial ecosystem is approaching a tipping point. The surge to $5,000 is a reflection of systemic stress, not speculative excess. Why ordinary investors often miss the warning. Most retail investors focus on headlines, charts, and short-term indicators. They do not track hidden debt accumulation, derivative exposure, or central bank gold accumulation. This is why gold often rises before collapses are recognized. The system moves first, public acknowledgement comes later. 5,000 gold is a culmination of structural imbalances already in motion, a warning and a guide for those paying attention. Conclusion, setting the stage for part 2. The $5 trillion trap is set. Debt, leverage, and overstretched policy tools have converged into a scenario that cannot be fixed with conventional solutions. Gold has already begun to reflect the stress, quietly signaling what most of the public cannot yet see. In part 2, we will explore why gold's surge to $5,000 is inevitable, how it interacts with systemic stress, and why it performs as a prelude to a broader financial reset. Gold is not speculative. It does not wait for news cycles, analyst reports, or public recognition. It reacts to structural truths in the financial system long before anyone else notices. The $5 trillion debt trap, set in motion by decades of leverage, overborrowing, and policy intervention, has already created conditions where gold's rise to $5,000 is inevitable. Not probable, inevitable. 1. The structural imperative. Gold behaves differently than stocks or bonds because it represents tangible value, not promises. Currencies are faith-based instruments. Bonds are contracts dependent on repayment. Stocks are claims on future profits. Gold is real, physical, and universally recognized. When debt accumulates to extreme levels, as in 2026, confidence in promises begins to waver. Markets recognize the fragility before policymakers admit it. Gold becomes a mechanical response. It does not speculate, it corrects. The $5 trillion in new debt is not just a number. It is a signal that existing currency and debt structures are being stretched beyond sustainable limits. At this stage, every increment of new debt accelerates stress rather than supporting stability. Gold reacts to stress before panic. Its rise is a reflection of systemic imbalance. 2. Central banks and strategic positioning. Central banks around the world understand the invisible pressures mounting on the system. They are quietly accumulating gold at unprecedented rates, both as insurance and as a tool to maintain optionality during crises. When central banks shift reserves from dollars into gold, they are signaling an acknowledgement of systemic risk. This behavior is not about short-term profit. It is about preserving value when fiat systems fail. Elites and institutional investors monitor these signals closely. The $5,000 gold level is derived not from market speculation, but from anticipation of structural stress, debt, policy exhaustion, and confidence erosion. 3. Gold versus fiat. The inevitable divergence. Fiat currencies are inherently vulnerable to overextension. They depend entirely on trust in central banks, governments, and institutions. As obligations mount, trust diminishes. Gold, by contrast, is immune to counterparty risk. Its value is not determined by promises, but by scarcity, durability, and global recognition. As confidence in fiat erodes, the market reallocates. Investors, banks, and governments shift capital into gold, which becomes a safe haven, absorbing stress from failing currencies. This dynamic ensures that gold does not move linearly. It accelerates as trust collapses. The surge to $5,000 is the natural consequence of this reallocation under pressure. 4. Leverage and liquidity stress. Modern financial markets are highly leveraged. Derivatives, ETFs, swaps, and synthetic products create enormous exposure. When debt levels reach extreme heights, any loss of confidence triggers cascading effects. Gold benefits in 2 ways. Safe asset demand. Investors shift capital into tangible, liquid assets. Liquidity drain on paper markets. As margin calls hit leveraged positions, liquidity flows toward gold, driving prices higher. This self-reinforcing loop ensures that gold accelerates ahead of market collapses. The $5,000 level is less about speculation and more about systemic mechanics catching up with reality. 5. Historical precedent. History consistently confirms gold's role as an early responder. 1929, 1933. Gold rose in real terms before banking collapses, as confidence in fiat contracts eroded. 1971. When Nixon ended gold convertibility, the price surged as markets anticipated currency revaluation. 2008. During this financial crisis, gold rose as trust in financial institutions and paper assets collapsed. Each case shows the same pattern. Gold responds structurally, not emotionally, signaling instability before mainstream acknowledgement. The $5,000 target reflects the culmination of these structural pressures in today's context: extreme debt, leveraged markets, and exhausted policy tools. 6. Gold as an early warning indicator. Unlike most assets, gold does not lag crises. It anticipates them. It rises when debt overwhelms the system. Liquidity tightens unexpectedly. Real yields turn negative, making cash a losing proposition. Central banks signal stress through accumulation. Trust in fiat weakens globally. The $5,000 surge is not speculation. It is a natural response to stress signals already present in the financial ecosystem. Gold is essentially the thermometer of systemic health, and the reading is already overheating. 7. The psychology of the surge. Investor psychology amplifies the movement. As gold rises, it validates early holders' understanding of systemic risk. This creates a feedback loop. Early movers accumulate physical gold. Market signals reinforce belief in gold's necessity. Latecomers rush in, amplifying demand and accelerating price. Unlike other assets, gold's psychology is intertwined with trust, scarcity, and survival, not speculation or market hype. This is why the $5,000 surge is both inevitable and unstoppable once the stress is recognized. 8. The global dimension. Gold is globally recognized, which makes it a universal hedge. When confidence falters in the US, Europe, or Asia, capital shifts across borders. Physical gold, vaults, and bullion markets absorb stress that digital and paper assets cannot. This global network effect ensures that gold reacts faster than localized currencies or equity markets. By the time retail investors notice, gold is already accelerating toward the $5,000 level. Conclusion. Preparing for Part 3. The $5 trillion debt trap has set in motion structural pressures that guarantee gold's surge to $5,000. It is not a speculative top. It is not hype. It is a mechanical, inevitable response to systemic stress, leveraged markets, depleted policy options, and declining confidence. In Part 3, we will examine the mechanics behind the surge, how gold accelerates, and why timing and scarcity combine to create a perfect storm for $5,000 gold. Gold's surge to $5,000 is not a random spike. It is the result of interconnected forces combining structural imbalances, market psychology, scarcity, and systemic stress. Understanding these mechanics is essential to grasp why the $5 trillion trap inevitably leads to gold's historic rise. 1. Leverage amplifies movements. Modern markets are built on leverage, derivatives, swaps, ETFs, and margin financing. These instruments work under the assumption of stability. When debt reaches extreme levels, small shifts in confidence can create disproportionate reactions. Margin calls force the sale of assets. Liquidity becomes concentrated in fewer hands. Institutions scramble to reduce exposure, creating cascading effects. Gold is the natural refuge. Its rise is accelerated not only by fundamental demand, but also by liquidation pressures elsewhere. Every position closed in equities or bonds can redirect capital toward tangible, secure assets. This self-reinforcing loop ensures that once stress becomes visible, gold's price accelerates rapidly, making $5,000 not speculative, but inevitable. 2. Scarcity and physical demand. Gold is finite. Unlike currencies, it cannot be printed or created on demand. As central banks and wealthy investors accumulate reserves, physical supply tightens. Refiners and vaults cannot increase output instantly. This scarcity adds a critical layer to the surge. Prices do not rise because of hype alone. They rise because the available gold is constrained relative to demand. In periods of crisis, physical delivery matters. Paper claims may lose credibility. Gold bars, coins, and allocated vault holdings become more valuable as trust in intangible assets wanes. The $5,000 level reflects not only structural stress, but also physical scarcity, which accelerates the price upward as markets realize supply cannot meet demand. 3. Global reallocation of wealth. Gold is a global asset. It responds to crises anywhere because its value is universally recognized. When confidence in fiat currencies erodes in one region, capital flows to gold globally. Emerging markets, where wealth preservation is paramount, begin accumulating gold. Institutional investors, anticipating systemic risk, move their allocations toward tangible assets. This global reallocation magnifies the surge. Unlike stocks, which may react to localized news, gold reacts to cumulative global stress, pushing it higher as more participants recognize the threat. 4. Real yields and negative interest rates. Modern financial systems face a paradox. Interest rates are low or negative, yet inflation continues to erode purchasing power. Real yields, the return on savings adjusted for inflation, are negative in many major economies. Negative real yields make holding cash a guaranteed loss. Bonds, which historically offered security, no longer provide meaningful protection. Gold, as a non-yielding but stable asset, becomes increasingly attractive. Its value does not depend on counterparty risk, interest rates, or policy promises. 5. Investor psychology and herd dynamics. Gold behaves differently than typical assets because its rise is driven by trust and survival instincts, not speculation. Early holders perceive risk and accumulate. Price increases validate their decisions, creating confidence in gold as a safe haven. Latecomers observe the surge and rush in, accelerating demand. Unlike equities or crypto, where hype can be fleeting, gold's psychological momentum is rooted in structural necessity. It does not crash on rumors or sentiment. It moves in response to real systemic pressure, which compounds the surge once it begins. 6. Central bank signaling. Central banks are both participants and signals in the system. Their behavior impacts markets before policy announcements are public. Accumulation of gold reserves signals systemic stress. Selling or withholding assets communicates risk management priorities. Coordinated action among multiple central banks magnifies the effect. Markets observe and react. Gold prices often rise ahead of formal recognition of economic instability, reflecting the unseen positions and expectations of global financial institutions. The $5,000 surge is as much a response to institutional positioning as it is to underlying fundamentals. 7. The feedback loop. The surge is amplified by a feedback loop between scarcity, leverage, psychology, and global reallocation. Debt stress rises. Confidence in fiat diminishes. Investors accumulate gold. Scarcity increases. Scarcity drives price higher. Latecomers enter. Feedback accelerates. Market leverage amplifies movement. Forced liquidations redirect capital to gold. Rising gold confirms systemic stress. More accumulation occurs. This feedback loop ensures that gold's rise is rapid and self-reinforcing, explaining why $5,000 is not a distant possibility, but an inevitable consequence of systemic pressures. 8. Timing and predictability. Unlike speculative assets, gold does not require prediction of exact events. Its mechanics are observable. Debt levels, leverage ratios, central bank positions, real yields, global liquidity. Each of these variables indicates when stress is building. The timing of gold's surge is mechanically determined by the interplay of these factors, not by random market sentiment. $5,000 gold is predictable once these conditions are understood, and the mechanics are already in motion. Conclusion. Preparing for Part 4. The mechanics of the $5,000 gold surge are clear. Leverage amplifies movement. Physical scarcity constrains supply. Global wealth reallocation drives demand. Negative real yields favor gold over cash and bonds. Psychology and central bank signaling reinforce momentum. Feedback loops accelerate price action. Gold does not wait for crisis headlines. It responds to structural signals that most investors do not yet perceive. In Part 4, we will explore the endgame. What happens when gold hits $5,000, how the dollar system is affected, and what strategies will preserve wealth, concluding the script with a strong like and subscribe CTA. Gold at $5,000 is not a number. It is a statement, a signal, a reflection of systemic stress that can no longer be ignored. The $5 trillion trap has matured. Debt levels, policy exhaustion, and diminishing confidence converge to create conditions that cannot be stabilized with conventional tools. At this point, gold is no longer optional. It is the ultimate arbiter of value. 1. The breaking point. Financial systems rely on trust. The dollar, like all fiat currencies, is a promise backed by faith in institutions. When debt surpasses sustainable thresholds, when central banks cannot counteract inflation or deflation effectively, trust begins to erode. At $5,000, gold is reflecting the loss of confidence in the dollar system. This is not speculation or panic. It is the natural response to a currency that can no longer maintain purchasing power against unprecedented debt. The breaking point is characterized by rapidly rising real-world prices for essentials, volatility in stock and bond markets as leverage unwinds, liquidity strains in banks and credit markets, accelerated accumulation of gold by institutions and wealthy investors. This is the stage where the system transitions from fragile stability to inevitable reset. 2. The role of scarcity and physical demand. Gold's finite supply intensifies the impact. As the surge accelerates, physical gold becomes increasingly scarce. Vaults and refiners cannot meet demand instantly. Delivery premiums rise sharply, reflecting tangible scarcity. Investors shift from paper contracts to physical possession, further tightening supply. Scarcity ensures that $5,000 is not a theoretical number. It is a market-clearing signal. When gold reaches this level, those holding it control access to a form of wealth immune to systemic collapse. 3. Systemic reallocation of capital. Gold's surge triggers global capital reallocation. Sovereign nations diversify reserves, moving away from over-leveraged currencies. Hedge funds and private institutions liquidate risky positions to secure tangible assets. Retail investors follow, increasing demand and accelerating the feedback loop. This redistribution is both reactive and anticipatory. Markets price in the inevitability of systemic failure before it becomes publicly visible. Gold, as a universally recognized asset, absorbs capital that fiat systems can no longer safeguard. 4. Psychological momentum and herd dynamics. Gold is unique because its rise is driven by structural necessity, not speculation. Yet psychology magnifies the surge. Early movers recognize risk and accumulate gold. Rising prices validate their foresight. Latecomers, observing the surge, rush in, accelerating demand. Fear of missing out amplifies momentum, creating a self-reinforcing cycle. The surge to $5,000 is thus both mechanical and psychological, combining systemic stress with human behavior to create unprecedented price movement. 5. Dollar system consequences. The dollar system suffers multiple consequences as gold rises, currency devaluation. The purchasing power of the dollar erodes rapidly. Interest rate instability. Central banks struggle to balance inflation control with liquidity support. Debt defaults and restructuring. Governments and corporations face challenges refinancing obligations. Global ripple effects. Economies dependent on dollar-denominated trade experience stress, leading to geopolitical tension and market volatility. Gold at $5,000 reflects the market assessment that these pressures cannot be mitigated without a structural reset. 6. The reset and recalibration. When gold hits $5,000, the system begins its transition. Alternative currencies and settlement mechanisms gain prominence. Physical assets, including gold and essential commodities, become primary stores of value. Financial institutions and governments restructure debt, often at substantial cost to paper wealth. Market hierarchies shift, rewarding those prepared and penalizing those reliant solely on fiat. This is not chaos for its own sake. It is a recalibration of value, aligning tangible assets with systemic reality. Gold acts as both barometer and stabilizer, guiding participants through the transition. 7. Survival strategies. For those observing the signals, preparation is key. Accumulate tangible assets like gold and other physical commodities. Diversify exposure beyond single currency dependency. Monitor central bank policies and global liquidity trends. Understand leverage and risk in traditional financial positions. $5,000 gold is a warning and a guide. Those who recognize it can preserve and even grow wealth, while those unprepared face erosion of purchasing power and market disruption. 8. Historical context. History provides perspective. 1929, 1933, banking collapses followed periods of rising gold prices. 1971, ending the gold standard led to rapid currency realignment and gold appreciation. 2008, gold surged as trust in financial institutions and paper assets faltered. In each case, gold signaled systemic stress moment before the broader population realized the depth of the crisis. The $5,000 surge follows this historical pattern, a mechanical, predictable reflection of systemic stress rather than speculative excess. 9. Global implications. The implications of gold at $5,000 extend beyond individual wealth. International trade begins to rely more on tangible or diversified assets. Geopolitical influence shifts toward nations holding reserves outside over-leveraged currencies. Financial strategy evolves from paper-based dominance to asset-backed security. Gold is no longer a passive store of value. It becomes a primary medium of survival in a stressed global system. Conclusion, script ending in CTA. The $5 trillion trap has forced a reckoning. Gold at $5,000 is not an accident. It is the mechanical outcome of debt, leverage, scarcity, and declining confidence. The dollar system cannot maintain purchasing power under these conditions. Physical assets, particularly gold, become the ultimate arbiter of value. Understanding this surge is essential. Gold is not speculation. It is a reflection of reality, a prelude to systemic recalibration, and a guide for those navigating uncertainty. If you want to stay ahead of global financial shifts, hidden systemic risks, and understand the forces shaping wealth and currency, like this video, subscribe to Hidden History Vault and be ready for what comes next.